Hey, this is Mike, and today I want to do a video on how to avoid panic selling because panic selling is one of the biggest sources of losses in any portfolio. I know because I used to do it all the time when I started trading. I started trading back in 1998 during the dot-com boom, and that was a time where you can literally buy any stock that had the word .com in it, and it would go up 10, 20% a day, and the stock would double every quarter. And I did that, and I thought the stock market was so easy that, I could make $1 million before the time I was 25. And then the stock market crashed in 2000, where you had the NASDAQ literally went down 90%. It went from, or 80%, it went from 5,000 to 1,000 in the span of a couple of months. And of course, my portfolio at the time went from like 150,000 to like maybe like 30,000, and I literally sold at the bottom. So what I wanted to do was just share what I learned at that time, like 20 years ago, and show you how I avoid panic selling, and that has saved me from blowing up my portfolio. Like, I haven't blown up my portfolio since. So these are the kind of 5 thoughts I have in my head when a market begins to sell off and go real bad, and this has helped me hold on to my position. So the first thing I do is I want to know why the market is selling. Is the market selling? Usually the market will sell because it becomes overheated. I would say maybe 50% of the time the stock market just moves up really far, really fast, and it needs to have a reversion to the mean or take a breather, or people just sell. And at that point, I realize, okay, this is probably going to last anywhere from a couple days for a couple weeks. I'm just going to have to ride it out. Sometimes the market falls because of geopolitical tension, or somebody said something, whether it be the president or a leader from another country. And unless the market is falling because of something that really affects the specific assets that I hold, I just tend to hold on. So it's good, like, more knowledge is better knowledge. If you just look at the market that's falling, you can panic and sell. But if you know why the market is falling, that gives you more resilience to not sell the stock. Know why you purchased the asset in the first place. So, for instance, if you purchase Tesla because you believe Tesla is going to disrupt the auto industry, you don't want to sell just because Tesla had 3 or 4 bad days in a row and it's lost 20% of its value after rising 100% in 50 trading days. If you want to hold that stock long term, then you have to write it out. Amazon fell 90% from its peak in 2000. Berkshire Hathaway has fallen 50% 3 times in the past 50 years. If you have a good reason to hold the stock long term, then you should have no reason to sell it unless there's something materially wrong with the company, like if there's stock fraud or something like that. Also know if it's a long-term or short-term trade. Look, if it's a short-term trade and the market's doing bad, then you're probably going to want to get out. However, in most cases, I think usually like 90% of your portfolio should be long-term, and then 10% should be short-term speculation. So that means when the market sells off, you should only sell if you're trying to do like a short-term trade on the NASDAQ or a short-term trade on gold or something like that. Know the difference between what you hold in your portfolio, if it's long-term or short-term. If it's long-term, you don't want to sell just because the market fell. But if it's short-term, you go ahead, preserve cash so you can find another short-term opportunity. The fourth thing is, do you need the money right now? Now, ideally, you should not be putting money in your brokerage account if that's money you're going to need for, like, I don't know, rent or mortgage, or you need to make a payment or something. But unless you need the money like right now, you should not sell your stocks or your options or whatever your investment portfolio. I know some people, their emergency money is also their brokerage money. It would be better if you can put, if let's say you have $30,000, maybe you put 25,000 in your brokerage and leave 5,000 as your emergency money, because you don't want to be in a position where you're putting your emergency money in the market and then you got to pull it out as soon as you need it. I know it's better to always put cash to work, but when it comes to emergency money, it might be better just to have it in the site so you don't commingle both of these types of monies, because you don't want to sell because of emotion. You don't want your emotions tied to your investment portfolio. And finally, also realize that the biggest up days are follow the biggest down days. And if you look at a chart of like the biggest up days, you'll find they're in like 2008 during late September. The biggest up days were in like 2020 of April. So when you do have days that are down 3, 4, 5, 7%, usually within like 10 trading days, you're going to have big up days. You're going to have 4, 5, 6% up days. So just realize that, because the last thing you want to do is sell at the bottom. Selling at the bottom, you not only lose money from your losses, you lose money because you don't buy back in, and then you continue to lose money because then you're scared to go back into the market. It's like you almost lose 3 different ways. So just realize that when you have these horrible sell-offs, usually there's a pretty violent recovery. So those are my thoughts on trying to hopefully help you avoid panic selling so you can preserve your capital. As Buffett has always said, the first rule of investing is don't lose money, and the second rule is don't ignore the first rule. So I hope you enjoyed this video. If you did, please be sure to like, share, and subscribe. Turn on notifications, because I do multiple videos each day on the market, and I also do occasional like educational videos on investing. Okay, thank you very much. Bye.